Chinese stocks are pumping, so you might be wondering whether it's just a dead cat bounce or it can actually go up a lot further. Now, speaking of China, we have some new updates on Moomoo, and now they can trade Hong Kong shares.
Yes, exactly. And if you're a new user, you can get 180 days of zero commission when you buy Hong Kong stocks and China A stocks in Moomoo. But for existing users, you only got 30 days of zero commission. And make sure to use our code FIRL24 to get your 40 ringgit cash voucher.
Okay, so if you didn't already know, Hang Seng Index and the CSI 300 has experienced a very nice bounce over the past week or so. Lots of this happening because the Chinese government decided to engage in a stimulus,
Yes.
which is just another word for pumping money into the stock market.
Yeah.
And if you know the Chinese and Hong Kong stock market over the past couple of years, it has been quite painful. So you can see the Hong Kong one, it's since 2021, it's down. Yeah, you can see on the screen and pause. Same with the CSI 300.
Yeah, but why they decided to save the market, it has to do with obviously the property crisis. The China Evergrande, that one is a major crisis for the Chinese home buyers. Most of them actually who bought property from them are facing abandoned projects. So that means they are still servicing loans that the property that they cannot just get it. So that is one of the impact that the government is trying to solve. And also another thing is that 75% of these Chinese steel industry or companies are actually facing a wave of bankruptcy. So they are making losses for the first half of 2024. And the government see that something needs to be done.
But why this is pressing is because a lot of China's economic growth has been based on, steel, has been based on a lot of manufacturing. And it's not just the growth that's really good. It's also the fact that these companies hire a lot of people. So when China is trying to save these companies, they don't really care that much about the losses. In fact, a lot of these companies are what we call SOEs. So they are state-owned enterprises, meaning China does not really need it to be very profitable. I read somewhere that the average SOE has a 2% profit margin or less. So they really don't care profit, but they hire a lot of people.
Yeah.
Right. So China now is transitioning from old economy to new. So Alibaba's, Tencent, and guys like that.
Yeah.
But they don't hire as much people as a steel factory. One steel factory can have 10,000 people, but you can Google how many people are hired in Alibaba.
Yeah,
right?
And right now they also want to consolidate most of their steel manufacturing to just maybe top 5 to top 10 only. So they are trying to pump in more liquidity to save some of these companies.
Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description.
So this is the remedy that what causes the Hang Seng and China CSI 300 to pump up. Bunch of stuff. Cutting rate cuts and also injecting more liquidity to the banks so that banks can lend more loan or cheaper borrowing to companies. Yeah. So that is just a summary of it. But if you want to know the extensive explanation, this is the entire thing.
Yeah, it's also important to add that China has a semi-peg. I'm not sure if you know. The yuan is semi-pegged to the US dollar. So it has to not 100% track, but it has to track quite closely to the US dollar.
So when the US cut 50 basis points, they also have to cut in a way.
But it's not like Hong Kong. Hong Kong is a straight up peg. I think 1 to 7, something like that. But this one is a managed float.
Yeah. Oh, okay. And also one more thing that I forgot to include, which is they're also going to lower their existing mortgage rate. And I believe for the second property, they're going to reduce the down payment from 25% to 15%. So that's also another way to encourage. So what this means, cheaper borrowing, more money. They're also going to give cash handout to the extreme poverty. This is so that they can encourage more spending and less savings and increase companies' debt also. Basically, they're just going to charge them 1.75% interest, where their dividend yield is actually 5%. So they can constantly buy back their shares and then hopefully,
Yeah, and this is a lot of people find this to be, a lot of investors find this to be exciting, right? Because it's using more or less free money to buy companies that are stable. And they're very excited. So
Yeah, so as a result, you can see most of these like major retail companies are up like 35%, 37%.
Half of these companies are half of these companies are actually in FIRL Pro. So
yeah, so make sure to check out using the 10% coupon in the description and comments.
If you were part of the FIRL Pro community, you would have discovered that it was time to go in early on.
Yeah. Okay, the real question right now is whether is this bull run sustainable?
Yes.
I think this is the number one question that investors want to know. So there's two parts that we can look at. One is inside China. There's a few initiatives that the government did in the past to, in a way, try to stimulate the spending within the Chinese residents. So number one, they tried to do this thing called the income tax relief. But the sad reality is that it is a minimal relief only because 5% of the population earn more than 5,000 yuan a month and pay income tax.
Sorry, 5% of the population earns
5% of the working those income earners.
So that means 5,000 yuan. I don't know what's the exchange rate now, but I think it's probably 3,000 ringgit.
Yeah, around there. And then which means 95% of them are actually middle income to lower income. Yeah, it's quite. I initially I thought that the income inequality gap is getting short. Is narrow, but then it's not. Yeah, it's still technically it's still the same. And then that's why you can see that even though they introduce all of this income tax relief, right, it doesn't really benefit the 95% because they are not really paying a lot of tax already to begin with. Maybe only a little bit. So it doesn't really encourage more spending from the people who is in the middle income and also the lower income bracket group. Yeah, so you can see this is the breakdown from some of the sources that we find over here. 5% only, very small. They are earning 5,000 and above. And then you can see that about 25% are middle income group, and the remaining 65% are the remaining, is my math correctly? 25, 20%, 35, 37. The remaining 70%, it is below income, which their average income is around like 800 renminbi per month. Very, very low only. And you can see this is their tax rate for each of these income bracket, which is, it's still going to be targeting the upper middle income category. Now, the second thing is the welfareism to prevent free riders. I think this is something that the President Xi Jinping did mention a lot. Like they want to promote common prosperity, but they don't want to promote things that can make the Chinese residents to be lazy. They don't want to promote lazy behavior. Like, for example, they don't want to increase the social benefit, like the unemployment benefit, because they think that, if we
European
increase
style,
yeah, correct. If we increase it, means more people don't want to get employed. They're just gonna tang ping. So tang ping is just laying flat. Only. Yeah. They try to like minimize that laying flat culture. So that's why they are not giving much benefit. So which means technically you cannot really boost consumption within them. And let's say if they do increase the social benefits, right? They cannot reduce the benefits really because people are expecting the benefits to be up there. It will just be there or it will increase, never decrease. Now, instead of spending much on the on the social benefits, they instead use most of the money to spend on infrastructure. So you can see like your infrastructure, manufacturing, you can see the infrastructure share of GDP, it is around like 4.8%, if I'm not mistaken. And it has been growing a lot ever since. And you also need to know that China's economy right now, it is investment-led gain driven.
Yep.
So which means, they're investing on infrastructure, investing overseas.
As opposed to what a developed economy is, which is consumption.
Yes.
So, the way I would explain it simply is if you look at the breakdown of a GDP, you have 4 components: exports, government spending, fixed assets, infrastructure spending, and investment-led rather, and then consumption, right? So exports, China is pretty much flat thanks to the trade war. Government spending is government spending. And so really the 2 defining factors for a country's economy is either investment-led or consumption-led. Most countries start off investment-led because it's easier. So you just build stuff and people get hired. But at some point, you will not have to build so much stuff,
Yeah.
then you would have to rely on something new to grow the economy. So developed economies like the US is 60-70% consumption led, where it's the people's ability to spend that spurs the economy.
Yeah.
But China, if I last checked, is still sub 40%. So that's why they have to rely on fixed assets. If they do not grow their fixed assets, the GDP will not grow. This also explains why a lot of companies in the fixed asset space, like steel, like real estate, are going bankrupt.
Yeah.
Because they have to take loans to grow. And one thing that's not shared here is the loan growth as well in China, corporate loan growth. They have to take the loans to grow the GDP because they have a KPI, right, for the government. But by doing that, then they increase the risk of bankruptcy. So now when China's trying to curb all this, you will start to see in the GDP numbers going forward that it's going to drop. And in fact, it's already lower than Malaysia.
Yeah.
And this is with Malaysia having, if I'm not mistaken, 60% consumption.
Quite a dire state. And also kind of explains why the Chinese residents' household debt is above 100%, which I'm going to share later. Yeah. Okay, so yeah, this is another few interesting initiative. The third one is unfortunately, education and medical facilities have been underinvested for quite some time. But the good thing is that their insurance coverage, that one is okay because I think that one they did a good job. 90% of the populations in China are actually medically insured. This is according to them. We don't know whether this is true or not, whether the facts and data is correct or not. But then that's what it says in the secondary source. Now, the reason why they are not spending a lot is probably also because they are spending more money on the infrastructure side of things instead of that. That's why you can see like the differences, right? The domestic general government health expenditure as a share of GDP, it is less than 4%. It's around like 3%-ish. And it's one of the lowest. You can see that after that is Indonesia already. And then the next one is their education spending also has dropped a lot. It is also about 4%.
Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description.
But if you compare to other nations, the developed nations, even India, they are spending quite a lot in terms of education. So this is another interesting fact that they are not spending much on that, and which also results why most of the Chinese residents are saving more money for this. Because number one, some of their medical insurance cannot really cover fully. So they have to save in case like something bad happens, right? They have the excess money to actually pay for it. This is not only just the below and middle income group, but the upper income also, they are quite scared of this. So that's why they have been
they don't have
saving a lot of money.
Social safety net. They don't have like Malaysia. You can get a childbirth for a few hundred ringgit.
Yeah. And also because they only have like one child policy, so definitely they need to spend money on education. So they are also saving money for that, just in case only. And you can see that this is evident from the proportion of population with household spending on health is greater than 10% of total household budget. So you can see that China is one of the top, that they are actually spending a lot more money on health, which is why they have to save more money for these kind of reasons. Now, the fourth thing is that unfortunately, 60-65% of China's total saving is only held by the top 10%.
But this is a global problem, right? It's not just...
it's an 80-20 rule. It's like always the rich people have the one that is having the most savings. And yeah, the rich also, they are not really spending a lot. You can see this is their consumption growth over the past 10 years. You can see the consumption expenditure per capita, which is the yellow color line over here. Initially, go up a little bit. This is post-COVID. Or actually, post-COVID, and then after that, it dropped down a little bit because this was the Evergrande crisis. Then it kind of like trickled back up a little bit, but then it dwindled down again.
Yeah, but you can see, I think the big one is retail sales, which should track consumption expenditure, right? This is signs of developing into a consumption economy. Basically, when we think of, when your relatives say, or Chinese people are very rich, what they're really talking about is that 10% household or like higher. Most Chinese people do not have that kind of spending power, as you can see from the stats here. And this is straight out of their own statistics, right?
Yes, exactly. Then you can see those famous like those platforms like Alibaba, Tmall, right? They also, Alibaba have to reduce their price in order to boost like more
There you go.
spending. Yeah. So it actually has been a very, very dire state over there. Now, the last one over here, if you guys didn't know, property, it is one of the important asset for Chinese people to have. Even it is a culture over there. Like if you don't have property, chances of you getting married is actually zero.
Yeah,
you need
房子.
yeah, you need 房子, you need 车, which is car and all the stuff. And in order to get a property there, they have a very high debt service ratio, which is actually very concerning. Means
That's crazy.
Yeah, they are allowing them to leverage more, probably even more than they can, whatever they can afford. So in Malaysia context, right, the debt service ratio is around 30%.
Yeah, recommended. Yeah.
Recommended. This is very, very strict. And then for public bank, I think it's even lower if you can.
And I think also the down payment.
The
down payment here is like 10%. There is, I think,
25%. But then they kind of like drop it for now. For now, they drop it a little bit. So they allow like 50%, specifically just for mortgage rate only. So that's why you can tell that why each of the household in China residents are actually quite high because of mortgages. Yeah, and you can see that this is their home ownership rate, which is about 80% of Chinese population own a home. So which means all of them are debt, 50% in debt with mortgages. You can see the debt to household income is also increasing a lot. It's actually more than 140%. Yeah, it's quite crazy. If you compare,
they are. And then if you look at, it's really higher than the US.
Yeah, you look at higher. Yeah, exactly. It's higher than.
And mind you, China is still a developing country.
Yeah, so a lot of these kind of like practices or initiative are actually making the Chinese residents very difficult to spend or actually to boost up consumption because of all of these tight debts. Now, recent years, after the crisis, obviously, more of them are more skeptical on properties. That's why you can see the number of them getting mortgage loan decrease a lot. And they are even in a negative territory, which means they are actively, clearing off their mortgage rate instead of spending to boost consumption in the country. And not only that, they are saving more money. So you can see this graph also. They are putting more money into fixed deposit, which is why the governments, when they see these facts, right, they think that, it's time to use the stimulus to reduce the interest rate that they can get so that they will save less and also buy more property with the lower mortgage rate. Yeah, but the current situation right now is they are settling a lot of stuff and saving. And what happened to Evergrande crisis is ultimately, this chart already shows a very skewed drop in terms of their confidence in the property, their willingness, employment, and also income. So all of this is actually just showing you that the situation right now in China is actually very bad, very, very bad. So nothing much to actually explain more.
Yeah.
Now, what's interesting is that some of the top investors are actually cashing out after this economic stimulus.
The context is there's one big interview with David Tapper, which is a top investor, and he's saying like, he's trying to buy as much China shares. And so by what you're saying is that actually they're people,
doing the opposite. Yeah.
It's like they're seeing this as an opportunity to
cash out. Yeah,
they basically think it's a dead cat bounce, right? They think it's not sustainable.
Yeah, exactly. So there you have it. The insiders are actually just going out, whereas the external fund managers in the US, everybody is getting in. Okay, so that's internally inside China. But what about outside of China? I think this one we have discussed a lot of time. Trade war is number one. And recently there is this the Middle East war tension, where the explosion of the Pager. Yeah. So that actually created more. It intensified the trade war between the US and China because they use that case study as like China saying.
And they say, China will do this.
Yeah, China also can do this. If Israel can do that, China also can do that. So which means it's not going to be ending very soon, and it's just going to intensify further. And not only just the US, but other countries as well, like Canada and even the European Union. They are kind of like throwing a lot of tariff against China.
So part of the reason why China's GDP has grown over the past 20, 30 years in a big way is because they can get a lot of trade surplus. So demand from developed countries, areas like Europe, US especially, will then spend money to buy their stuff. So they can take that money, basically use that money internally or for whatever.
Yeah, but this kind of like, I think they saw them grow too quickly already. So yeah, all of these things are happening. Okay, so that's about it. And the takeaway right now is whether this bull is sustainable or whether is it temporary. Well, some of our analysts, when I was reading some of the group chat, right, some of them think it is just a temporary bull only. Yeah, it's not gonna last for quite some time unless we see some of these consumption within their
The trend
country.
needs to change.
Yeah.
And the question is, okay, how would you actually change it? Right? Like if you, how did the US become that size, right? They are $25 trillion economy. So if 70% of that is consumption, what is the consumption amount? Let me do the math. Let's say it's about slightly under 20 trillion. So let's say 18, 19 trillion. Whereas China is an $18 trillion economy, but only 40% is consumption. So that is, how many is that? 7 trillion. That's quite 8 trillion. So it's 8 trillion versus 18 trillion. Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description. Did I get my math right? 18 trillion times 0.4 is 7 to 8, right? Correct, right? Yeah. So it's a big difference. And they can't really move the market. Like the US has so much money that it can basically buy other countries, help other countries by spending. But China can't really do that as much. Yeah, they can buy durians from us, that helps. And maybe raw materials from Australia and Saudi Arabia. But they have that issue. And so what is going to change? It needs to be a huge increase in GDP per capita, and so that they can spend. But historically, the reason that they can spend is because they built very export-oriented countries. They get money from the US, from Europe, and that serves as their income to either reinvest in the country or use it to, spend on consumption. But now that is gone. So what's left? Government spending. Well, government spending comes from the people. So, it's pretty much the same thing. Then the second thing is investment-led. But then investment-led, the country has to create credit for it to grow. And that's the opposite of consumption, right? So I don't see, and you guys can correct me wrong in the comments, but I just don't see a big boom in consumption. I see pockets of consumption. Our good friend Jonathan Choi said that, places like streaming services, places like luxury goods in that particular arena can recover, can do well because 65% of the money owns by 10%. But as a whole, I just struggle to see it. So if I can summarize, it's not so much I think that there's a bull or bear for this consumption. I do think consumption will grow only in certain pockets, in this case for rich people.
So now the key whether is the middle income and below 40, would they save more or spend more money? So this one we cannot really share much because we just don't know what is the situation right now. But we only can tell once more data is coming out in the next few months or maybe even years. So make sure the key one is to see the 65% or rather the 70% of the population, whether they will save or spend. Now the last one is whether the Western countries will impose more restrictive measures on BRICS, because obviously because China cannot do trade with US, or they're only doing lesser trade with US, the Western countries. So they are forming another ally, which is BRICS, Brazil, Russia, India, and China, and also other countries. So now the question is whether the Western countries will actually impose tariff against us. That will be another whole new discussion because this is just another wow factor or wow thought that you may need to consider, even though it may not happen, right? But it should be part of your scenario where assuming a global trade war just decided to occur, like out of the blue like that. But what do you think about the last point?
I think Western countries have always been talking about BRICS and trying to stay away from the US dollar. I think that's fine because, people don't understand why the US dollar or the petrodollar, right, they like to say, is so significant. it was done to control inflation because most of the oil came from OPEC. So OPEC grouped together and say, hey, US, don't mess with us, right? Because they were involved in the Yom Kippur War in 1973. So US say, oh, wait, hold on. Right? You guys can actually Google 70s inflation in the US. You can see, those big American roads, long American roads with all the mountains, all that. Then there's like one gas station there. Then you can see everyone lining up. It's an iconic photo, right, to capture the inflation in the 70s. They had to line up because there's a shortage. And gas went up, gas prices. So that was why they did it. So what the US did in response is they picked the most significant member in the OPEC, which is Saudi Arabia, and then say, look, stop this, but we will give you technology, we will give you weapons, we will help you on your foreign policy, especially against Iran, who you don't like, right? Because Saudi Arabia is Sunni Islam, Iran is Shia Islam, right? So don't like each other. Only thing you have to do is you have to trade your stuff in US dollars. Now, fast forward 50 odd years to today, scenario is to completely change because America does not need to worry about their energy concerns because they are now the largest producer of oil and gas, right? So energy independence is something that the US has been trying to work on. 50 years later, they're pretty much energy
self-reliant,
independent. So it's like, oh, you don't want to use the petrodollar? Okay, don't use the petrodollar, right? But then there are new reasons why the dollar is strong now. It's no more because of oil. The reason the dollar is strong is because the investments you can make. Now, so the whole irony is this, right? Let's say Saudi Arabia buys from, it sells oil to China, and they get the money. And let's say they get yuan or whatever currency they want to use. Are they going to put it in the bank? No, right? So what are they going to do? They're going to buy assets. Where are they going to buy assets?
US.
S&P 500. Or they go use it and buy football clubs in Europe, euros or pounds, right? So I can buy your stuff in whatever currency and there's a usage for it. And sure, it will increase the usage of the yuan or, whatever. But at the end of the day, I need my money to grow. And I'm not going to invest into Saudi Arabia. It's a desert. And I already have oil infrastructure. So you see MBS buying art, buying a bunch of things, and that's it. Where else can you go with that amount of money? Because this is hundreds of billions we're talking about, right? So you need a capital market, an investment platform, let's call it, that can absorb that kind of capital. Where else except the US?
Yep. So yeah, that's about it for today's video on China. So hopefully you are not super bullish on these kind of like temporary stimulus kind of thing.
But I want to say that it doesn't mean China's gonna die. China will never die. But just you need to pick your areas on where to do. I mean, look, our FIRL Pro portfolio has Chinese stocks, right? Don't get us wrong. You might think that we are. I mean, as usual, we like to bait you with our titles, but we are bullish on some China stocks, but we just don't have to think the whole market have to do well, then only we can do well in the market.
Yeah. Okay, so before you guys go, make sure to check out FIRL Pro because we're going to be increasing the price from 557 to 597.
And thanks to our Chinese stocks, we are up this month. Yay.
3%. Yeah, and not only just FIRL Pro, but the boring portfolio is up double. Last month it was at 4%. Right now it's 8.15%. Thanks to more investors are pouring their money into dividend stocks. So if you want to know more on FIRL Pro, it's basically we do a write-up for each of these companies that each of ourselves, our research team have high conviction on, and we will share with you guys our analysis on the company's business prospects, the management, the risks, and all of these interesting insights that you may not even find in the annual report. Sometimes it's just through management briefing or talking to CEOs or industry experts. So if you want to know all of this information, you can get it from FIRL Pro. And if you want to get a taste, a free sample is there for you as well in the description and comments down below. So that's about it for today's video, and we'll see you next week.
30 minutes.
Yeah.
Wow.